Good afternoon. Today is July 7th, 2026. I'm Michael Bilotta, Senior Advisor and Investment Strategist here at JNBA. And today I'm joined by two of my colleagues, Andy Buccanero, our Director of Investment Management, and John Foster, a fellow Senior Advisor and Investment Strategist as well. And one thing that we thought we'd do today is just pause for a moment now that we passed the midpoint of the year, provide a little insight into how we viewed things to date, where we might be right now and conditions surrounding, where we're currently residing. And then also we'd be remiss if we didn't provide a few thoughts for what the remainder of the year might bring. And before I turn it over to Andy, I'd like to say, wow, what a first half of the year it was, where at the end of first quarter, people felt terrible. And at the end of second quarter, people felt great. It was really the tale of two halves in the first part of the year due to some conditions, obviously, but relatively amazing. And it kind of just signals what a crazy year it's been already so far, continuing up on what's, I suppose, been a crazy couple of years. But Andy, why don't you give us a little insight as to what your kind of views were the first half of the year and maybe a little about where we sit today?
Yeah, thanks, Mike. And it's really interesting reflecting on the first half. We started the year coming off of 2025. Global stocks were hovering near all-time highs, and really that's kind of the only commonality between then and now. Again, two different time periods, but again, stocks are hovering near all-time highs. Obviously, what you don't see thinking about that is the ride we've taken on along the way to get there. There's just been a lot of headlines lately, whether it be the war in Iran, inflation, corporate earnings, the labor market, so on and so forth in a very short period of time. There's been a lot of curveballs thrown at the market, both bad and good. But as we started the year, I think the expectations were, relatively clear for the average investor. We expected inflation to continue to trend down. A high bar was set for corporate earnings to keep this bull market going. But really, the script has been flipped on a lot of that stuff. With inflation, for example, now we're starting to see a resurgence in that, just from effects stemming from the war in Iran, and that's going to be a big thing that the market's going to need to figure out moving forward. But as we are, it's been a good time to be a globally diversified investor, especially after the past couple of years where it seems that the only game in town was specifically U.S. large cap growth stocks. Things have rotated broadly out of that, which has been healthy. Over the past year, we've had non-U.S. stocks play catch up. Year to date, through yesterday's close, we have small caps and emerging markets leading the pack. So overall, there's been a lot of healthy performance from other baskets as well. So it's not all necessarily bad news, even though, especially at the end of Q1, it certainly felt like all was gloom and doom, just given everything going on in the world.
Yeah, that's a good point. And I'll say, too, the importance of diversification. It sometimes sounds cliche, but it's really in a year like we've had this year, there have certainly been times during the year when you've needed almost every asset class. International in the first quarter did better than the U.S. In the second quarter, it was small cap that did extraordinarily well. And the thing about diversification, too, is you have to be there already. You can't make the changes after something has already happened. So to create globally diversified portfolios, it's kind of like the insurance. You can't go buy the car insurance after the crash has already happened. You have to have it beforehand. And so along those lines, it's really paid its due this year. One of the things, too, just in the broadness of the participation is for a couple of years now, a record low number of stocks have outperformed the S&P 500 itself. I think in the 20%. So basically what that means is the index and then very few stocks did well, and narrowness of the advance and so on. This year, 55% of stocks have outperformed the S&P so far. So it's been a broader advance. It's been a better year for some active management and some different qualities within companies to do well instead of just that one narrow subset. I guess I could throw it to either of you here now, but just to say, is there anything that transpired or with where we're at today that's definitely different than what your expectations were coming into the year?
Yeah, I think everyone coming into the year was looking at rate cuts, right? We came into the year, Fed funds was sitting at, 3.5 to 3.75%. The 2-year note was down at 3.47%, so down below, 3.5%. To Andy's point, inflation had been coming down. Inflation back in January at rolling 12-month basis was just 2.4%. Fast forward now to midway through the year, inflation for the most recent reading in May was 4.2%. So inflation's gone up significantly, in part due to the war, in part due to tariffs, a variety of things going on there. And the 2-year notes responded accordingly too. We've talked about that a lot. The Fed doesn't really make these grand maneuvers. They basically just follow the 2-year note, around over time. And so when the 2-year note was below Fed funds, everybody was expecting cuts. Well, now with the 2-year note up at 4.16% today, well, it looks like the Fed's sitting there about 40 basis points below the 2-year note. A good chance that the next move would be a hike. So, I think that's the biggest thing that the markets really had to digest or grapple with. The earnings have been coming in good. We've seen the broadening out. Valuations, as we've talked about, especially in small cap and mid cap, where the market trades at 15, 16 times earnings, still very reasonable, even after the returns that we've seen, where they were up in the 15 to 25% range this year, whether you're looking at mid or small. So we've seen performance, but we've still seen the valuations remain reasonable. But it's really these kind of inflationary and rate pressures that's been the big surprise, as it felt like we finally had the toothpaste back in the tube on inflation, and now we're back to making a bit of a mess of it with the inflation rate creeping up here.
Yeah, and certainly a lot of that has to do with the war in Iran and what oil prices did and how they contribute to inflation. The big worry there being that if we're all paying $4.50 for $5 for a gallon of gas, that money can't go somewhere else because it's being paid at the gas pump. Now, that's just one example, but that then cuts to a decline in consumer spending, potentially then leading to a slowdown in the economy. And so the longer oil would have stayed elevated, and who knows, we're not done yet, so it might come back and things may be back up $100 again for a barrel. But the longer that stayed that way, the more dangerous it was becoming, I think, for that to happen with the consumer and so on. Andy, is there anything kind of that you see here or that we're surprised at that's different than maybe what we expected?
Yeah, I think kind of watching the prior 2 quarters earnings story play out has been interesting. When we started the year recapping Q4 2025, very, very high expectations for earnings, especially on like the hyperscaler side, these companies spending money hand over foot on CapEx. They were continuing to be rewarded leading up to that point. And then it seemed like, throughout January and February, investors were starting to get a little bit unnerved for that. And regardless of the implications of the war in Iran, it seemed like a very easy excuse to sell, take some chips off the table. Now, fast forward, not that long after that happened, Q1 2026 earnings were phenomenal, right? It was the 6th consecutive quarter of double-digit earnings growth, partially due to the pullback in the markets, but investors' expectations seem to have hit the reset button a little bit. But it was just, one of the best quarters on record, in my opinion, for earnings growth and earnings overall. So obviously, a lot of that is baked into the market right now. We've had a tremendous Q2 here. S&P notched its best quarter in over 6 years now. Now, the big question moving forward is how much can this continue to run? There's, everything's pointing to another solid earnings season next quarter. But is it going to be enough to meet investors' expectations? And it's just kind of been a difficult game to play here, back and forth.
Yeah, that's a good point. Whenever expectations get high and higher, it starts to become a worry because at some point the bar gets too high that you can't jump over it. And at that point, investors get disappointed. And depending on how high those stocks are trading, what the valuation is, there could be an air pocket below there where somebody says, I like the company. I even like the company as an investment, but I certainly don't like it at this price because the assumptions were all wrong or the assumptions were just too high. So I guess, John, turning it over to you, John, who keeps the crystal ball in his office, if you could just give us a sense, I guess, a few thoughts going forward here for the rest of the year.
I think from an overall asset allocation standpoint, in the first half of the year, we did get a little bit more cautious on equities. We have a lot of optimism in the market. To Andy's point, pretty high expectations for earnings. Sentiment that you at times could almost describe as exuberant, in terms of people just having the fear of missing out. versus the fear that they might be wrong and prices might go down. And so there's a bit of overconfidence maybe even in the market to some extent. And you put that against higher rate pressures, and you do kind of set up here, especially with some seasonality heading into midterm elections. Midterm elections in the third quarter, midterm election years tend to be a bit bumpy. So I wouldn't be surprised to see us have a bit of a pause here that at least refreshes a little bit, maybe sets up some opportunities. But overall, our asset allocation models and indicators that we follow due to some of these yield pressures and some of the excessive optimism, they've been a little bit more cautious here on the market, at least in the short run here. So it may be surprising for us to see a pause. And then normally after the dust settles after midterms, you do get some sort of rally into the end of the year. As far as where to look, I still think the areas that have been working well, to Andy's point, international, emerging markets, small caps. Just when you look at the market overall, right, you have large cap stocks trading at 21 times earnings, so 1.1% dividend yield, much better valuations, right? You're getting about 16 times earnings, 1.6% dividend yield for small. International, even better, about 15 times earnings and a 2.7% dividend yield. So you get more income, you pay less for a dollar of earnings for those other areas of the market. And those areas also have really good momentum. So, I'd say, still looking at those areas that have been driving a lot of the returns, which is nice as a diversified investor when for so long every dollar you took out a large cap punished you. Well, now having dollars in these other areas have really helped people out. So I'd say, stick with the areas that have been working, but also expect maybe some volatility here in the months ahead, just given, some of that optimism and some of the rate pressures.
Yeah, I think as the three of us sit here today, it would be very surprising to not get some sort of pullback at noticeable levels. John, you mentioned midterm election years, the average return. So that always can get skewed a little bit, but the average return in a midterm election year for the S&P 500 is 4.7%, whereas the other years, the average is 9.5%. And so just in that return alone, now there can be skews around that and, a lot higher than 4.7 and 9.5 or what have you, with a lot of volatility leading up to it. But to the point you made about, after that is from that low point during the election pullback, midterm election pullback, the best 12-month return out of all of them is the 12 months that follows. So again, trying to time the market or what have you can be a tough deal when you go from one day to the next of, worst stretch to best stretch. You have to be there, and so that's what's nice about these globally diversified portfolios and so on, and the strategies is that we've got a lot of our exposure spread around, some additional exposure in certain areas or others, but we're certainly covered. As we sit here today, and maybe both of you are really sound sleepers and it doesn't matter, but is there anything that keeps you up at night or, if you're the sound sleeper, anything that you wake up in the morning and think about that could either be problematic or something that you see as, wow, this could be the best opportunity of our lifetime? I guess you can go both ways, but anything that might be, either one of you can jump in, I suppose, with the first.
Sure, I can start here. For me, it would honestly just be the speculation that's going on in the markets right now. There's a ton of leverage. If you follow the money and the fund flows, it seems that you have investors kind of rotating from one thing to another, bidding things up and then getting out. I mean, you can look at gold for how that started the year and came crashing down. The SpaceX IPO is still unfolding as we see it, but that's another thing to keep an eye on. But in this day and age too, on the retail side, you have products out there that are 1, 2, 3 times levered, whether it be on a single sector, but now even on a single stock. So a lot of these names where there's been a lot of momentum behind them, without leverage, now you have more money and more leverage on top of that, propelling some of these names up several 100% to start the year. So all it takes is, one big pullback and it could really exacerbate things.
Right. Yeah, things can unwind pretty quickly when you start to see people get up and head for the exits. Other people tend to get up and want to head for the exits too. But John, anything on your mind?
I think from an opportunity standpoint, there's a lot of stocks out there that are in some of these maybe more boring sectors that really haven't participated as much, whether that be some of the consumer stocks, some of the retail names, some of the consumer staples out there. that are pretty boring businesses, but have a lot of cash flow, cash generation, dividend yields, or name brand retailers or name brand product makers out there that are pretty cheap and have really been left behind as people have seen them as a use of cash to chase their favorite, to Andy's point, favorite source of speculation, whether that be high flying stocks, cryptocurrency, other things. Over the last number of years, people have viewed maybe some of the more boring businesses out there as uses of cash to chase speculation. And now we're seeing some of those areas, to your point, Mike, as the market's broadened out here, we're seeing some of those areas get some flows on people saying, you know what, maybe 8 times earnings for a pretty boring business with a nice dividend yield isn't a bad thing. So we're starting to see that broader participation. So there's certainly opportunities out there, from a maybe catching us off guard a little bit standpoint. I'll put the new Fed chair out there. We went into that first meeting. Things were a bit more hawkish on the rate front and inflation front maybe than what we've gotten used to. I think after, call it a decade of Jerome Powell, we were very comfortable with the communication style. I think we all felt we knew what the next move was going to be. And now there's just a little bit more of a wild card where, we really don't know. He's trying to take away some of the tools that were being provided in terms of guidance. Were they great tools? No, probably not. But once you get comfortable with the system and you learn how it works, you're pretty, able to forecast the Fed's next move. I think we're sitting here today now in terms of the Fed guidance and a little bit more blind maybe, where we got to figure out how to read the tea leaves with Warsh versus Powell, where we're all real comfortable.
Yeah. Especially when he, is not one for forward guidance, in his own words. But I think that is going to be interesting too. And those were both good ones. Complacency is one thing, or maybe speculation is one thing that tends to, give me pause. The Fed, I was almost going to, because while he was confirmed, Warsh was mostly a Trump-picked person for that job. And so the key will be the Fed keeping and remaining independent and having the appearance of remaining independent. And so if there's ever a question of that and the office becomes, potentially politicized, I think we're all in trouble with respect to if the global central banks and the global economies can't trust the U.S. Federal Reserve, we've got problems. And I'm not saying that will be the case, but, that could be something out there that people will watch for. And right now, too, are they going to pay more attention to leaving inflation a little bit higher? Or are they going to pay more attention to the jobs market? Because really, at the end of the day, the Fed's got 2 jobs. It's either price stability or full employment. And, both of those, and which one might they give more credence to as we go forward the remainder of the year? But, obviously, there are things that we're not going to cover here and things that people are going to have questions on here going forward. But I wanted to thank everybody for watching and listening. Hopefully this gave you a little bit of insight into our thoughts on 2026 so far and going forward. And if you do happen to have additional questions, maybe either about things we covered or didn't cover, please reach out to your investment team or your JNBA Advisory Team, and we'll be happy to chat with you and direct you to the right spot. You can reach us at jnba.com. or our phone number at 952-844-0995. Thank you very much and have a great day.